Malcolm, how you doing? Good to see you.
I'm good, man. I'm good. Lots happening in the markets these days. Lots happening, in the news, politics, everything else too. But specifically in the markets, there's a ton happening.
Oh, we could do a politics show for 45 minutes to an hour right now. That would be a lot of fun in a different direction. For
Nobody wants to sit through listening to me rant about how we need to have a 3-party system in the United States.
I'll let you do that if you let me do my rant on banning all institutional money from buying single family houses in the United States. That could be a lot of fun. Let's get to let's do the show that people may actually be here for, or may just randomly found. I don't know why you're here right now. You could be here for any number of reasons. But I want to talk about Sam Altman on Brad Gerstner's podcast, specifically the leader of one of the hottest companies in the history of the world, getting a little fussy at a valuation question. Some stuff going on in the market with Michael Burry setting up a short against AI companies. You've got some thoughts on crypto. I want to talk about what's going on in the restaurant industry right now, and if I want to catch a falling knife with Chipotle, or if it's even a falling knife in the first place. And then one of the big themes, we're doing 2 shows this week that we're going to talk about at the end, is just the casinoification of the economy. What's going to be different about this discussion is not just the effects of it or thinking about it at a macro level, but what do you do if a lot of the economy is becoming a casino? What can you practically do as someone living through that? And I think it'll be a good conversation. So hope you stick around for it. All right, let's do it. So Malcolm, Sam Altman, he runs OpenAI, our favorite nonprofit, which I still haven't been able to donate to. I haven't found their donation page. But anyway, so Sam Altman goes on Brad Gerstner's podcast. And Gerstner asked him, he's a tech investor, a pretty basic question, which is, how can a company with $13 billion in revenues make $1.4 trillion of spending commitments? You've heard the criticism, Sam. And Sam Altman got kind of upset. He's like, if you want to sell your shares, I'll find you a buyer. 2 things happened there. One, Gerstner immediately backed down. He's like, no. I still want to be an investor in your company. And then, Sam kind of explained, he's like, oh, we're getting much more revenue from that. And it was kind of like, you don't understand what's going on. Yeah. So I'll throw it to you, Malcolm, because I'm not even the CEO of OpenAI, and I feel like I could answer that question for OpenAI.
Yeah. So one thing, calling Brad Gerstner just a tech investor is an understatement. And I know you weren't saying it to be reductive, but I want to point out that specifically because it also helps to highlight how outrageous it was that he responded to him that way, right? So Brad Gerstner was an early investor in Facebook, Uber. There's like 10 companies that we all know and love, and maybe I shouldn't say love. We all know and use on a regular enough basis, whether begrudgingly or enthusiastically. And so like the fact that he's got a stake in OpenAI tells you how important he is to the Silicon Valley ecosystem. Yet this guy just flat out said, if you don't want to be in the party, get out, right? So he's also in the middle of interviewing Satya Nadella, CEO of Microsoft, who happened to be their first big investor that helped get them to where they got to. And he dropped off of the interview abruptly. So I don't know if he, already pre-planned his exit or, whatever, but I'm not going to just jump out of a conversation with the CEO of Microsoft abruptly and leave him holding the bag and not to say like looking silly, but you know what I'm saying? Like if the most important person gets to leave the meeting first, it's clearly the CEO of Microsoft, not the guy who's hoping to raise enough capital to keep his company going long enough to hit that $1 trillion of spend that he's committed to. You just don't do it. So all of it just looks so bad. And I think that the reason that it matters for this conversation, you've heard me talk so many times about how important OpenAI's IPO is going to be to this entire AI ecosystem, maybe even the last step toward the air coming out of this balloon and the bubble starting to burst. I think it just reflects poorly on him and the company. But more importantly, like these are the kinds of questions he's going to get all the way up to and through an IPO. Like, if you think Brad Gerstner just asking you very plainly, you got $13 billion of revenue on record. How are you going to convert that into enough revenue to be able to commit to a $1 trillion of spend? Like, that's such a basic question. Imagine a JP Morgan Chase analyst asking you a 3-part question about actual metrics or the path to profitability.
Sell your shares. Sell them now.
Like, it's Elon Musk has pulled that move enough times, in the 15 years or whatever he's been doing these earnings calls. There's probably some room for those kinds of theatrics and people to be willing to stick with you. Alex Carpet is an example of this, right? The CEO of Palantir. Like, he answers questions very brusquely and waves people off and refuses to answer questions he doesn't like sometimes. So there's room for this kind of theatrics, but it just, for a company that is this important right now at this moment to the entire stock market, I won't even just say the tech sector or the AI ecosystem, specifically the entire stock market is running on AI right now. Just not a good time.
So a couple things to what you're talking about, Malcolm. One, I couldn't tell if that early exit was prearranged, because I can only imagine, just as someone who has booked podcasts in the past, if you are trying to find an open slot on the calendar that involves Brad Gerstner, Satya Nadella, and Sam Altman.
Yes.
So I don't know if that was is as we would say a rage quit or if it was predetermined. So I don't know. I don't know how much I can read into that angle. But to your point of what I'm hearing from you as well is that you're also not buying. You're not buying that Sam Altman has that like Elon Musk style in him. And I think one of the things that I'm thinking about here is just like, dude, you're one of maybe one of the smartest people on the planet, and you're doing it. You know what it reminded me of is do you remember when Rachel Zegler was like, I hate everyone who supported Donald Trump, and then no one is like, all right, then we're not going to go to your Snow White movie. And it's so easy. All you have to do, I'm a Disney princess and I'm excited to tell the story for people of all ages. Sam Altman, why is your company spending $1.4 trillion in like capital infrastructure commitments? Brad, you've seen tech from the ground up, and you've seen how these small, seemingly small amounts of spending, not that 13 billion is a small amount of spending, but we are at the beginning of an industrial revolution that is already changing the economy and the world you live in. This is how we continue to be number one, is by spending this money so our competitors don't get out ahead of us. Because I believe that AI may be more of a winner take all environment. That's all you had to do. You compliment the guy. You talk about how smart he is. What a good question you have. And then you just do your talking points. It's not that hard. It's not that hard. I don't even work in PR. Maybe I did because it was like a podcast thing. But anyway, that's all I've got on that. Let's do this Michael Burry short. So Michael Burry, he is the famed investor. I'm not just going to call him an investor. Famed investor after you got on me for Brad Gerstner. So he was in The Big Short. He called the mortgage bubble. Now he's got a bunch of put options against Palantir, against NVIDIA. And this has been making quite a bit of waves among retail investors because they're saying, or I shouldn't even say they're saying, it's easy to look at this and go, the guy who called the mortgage bubble is now calling the AI bubble.
Yep.
And some of those stocks, Palantir was hit on the news, but it's really hard to call the top of a bubble. Just what's your take on this one, Malcolm?
Well, it's hard to call the top. Nobody ever rings a bell at the top, as they say, right? But Michael Burry's whole everything is built around being the guy to call the top. And so through history, he's been short NVIDIA a bunch of different times and been wrong a bunch of different times. And so I think there's a bigger dynamic at play here where everyone is lining up to be the guy to call the bubble at the very top. Like, a lot of people are lining up to go on TV, get on podcasts, do everything they can in public forums to be seen as the dude that said today was the day, right? Jamie Dimon making his comments about when you see one cockroach in private credit, there probably are a ton more, has kind of helped start the unwind in that space. It was already starting to unravel and there were cracks showing, but I think he accelerated the bubble that he was referring to by referring to it, because Jamie Dimon is so important to Wall Street that when he speaks, everybody shuts up and listens. That is what I think we're seeing happen with AI too, where there's so many people who have a megaphone who are lining up to be the one to go on record today to make sure that it's clear that they were the one against the AI trade at this particular moment in time. And I think that retail investors are going in the opposite direction. And so far, for the last couple of years, retail investors have been the smart money at play here, right? So you have all these institutional investors that are selling out of the Mag 7. Bank of America just released their latest survey of their biggest institutional customer clients that says they're selling out of the Mag 7. They're reducing risk. They're going in other sectors. They're broadening, whatever. Retail says, hold my beer. I'm going to buy more NVIDIA, AMD, Palantir, whatever, because that's where the opportunity is. And eventually institutional follows retail as the pattern that we've been seeing for the last couple of years. So while we have these people making these giant bets against the AI trade and hoping to God that today is the day so that they can have a movie made about them too, retail is looking right through it and saying, I'm going to go make a few more dollars today while you guys are busy trying to form storm clouds over top of the markets.
I know you've also, as we're talking about investments, you've got some, I have no thoughts on Ethereum, so I don't actually have a good way of setting this up. But I know you've been really hesitant on crypto in the past, but for a reason you're about to explain to me, you're a little less hesitant about Ethereum right now.
Yeah, so I'm looking at Bitcoin specifically. I'm looking at gold specifically, and how the market is trading both of those things right now. And for Bitcoin, I'll just focus on Bitcoin because you asked me a crypto question. So $100,000 is the psychological barrier for traders in Bitcoin, that once it falls below it, people start to get concerned. And you have the bulls who will come in and buy it up to get it back above that $100,000 number, which is what's been happening for the last 5, 6, 7 trading days that I've been paying attention to it. So Bitcoin itself is down something like 17, 18% over the last month. Ethereum, however, is down almost 30% over the last month, which to me is where the real opportunity is if you're looking to trade it. I don't know anything about the long-term dynamics of where either one of these things is headed, the utility of it, the bigger adoption of it. There's a ton of institutional money in both of these things at this point, though, that I think is where the opportunity for it to be a trade that goes in the other direction starts to show. Because a lot of funds, BlackRock, for example, owns the 2 largest crypto ETFs, spot ETFs, right? You have State Street also has a really large spot ETF. All these different companies that have to step in and buy these cryptos. This is an opportunity for them to be buying it and backfilling on the cheap. And so I think you're going to start seeing more institutional buying in both of those, but specifically Ethereum, with it being down almost 30% now. That's just setting up an opportunity for retail traders to also take that ride along with it whenever crypto turns a corner, because we all know it doesn't go up and to the right forever. It generally takes you on a crazy roller coaster ride, and then you get to the end and say, oh my God, was that really worth it?
Yeah, and I've bought Bitcoin in the past. I should have held on to it when I was learning about it in 2018. Ethereum is, the case for Bitcoin has been pretty simple to me, which is that it's digital gold, right? It's almost like a reserve asset for people if you're losing trust in the globalized banking system. Ethereum is supposed to have applications built on top of it. Mm-hmm. And that's one where I just haven't seen the widespread use cases for those applications that have made me just kind of raise my eyebrows a little bit. But if you're just looking at the price movements, maybe it's a good idea, and I'll look more into it after we're done recording. Let me tell you about a company I'm looking at now. Okay. One that's also going on my watch list. And FTX. That is FTX. Shout out FTX. I used to have an FTX shirt. It was like FTX risk management department. And then it shrunk a little bit and I can't wear it. It was a great one. It was Good inside joke. Most people thought it was just boring corporate. Some people who knew. I want to talk about the restaurant industry because there's some stocks in there, former growth darlings, and one that had just been on fire for more than a little bit, just getting beaten up.
Red Lobster.
Tough place for the restaurant industry. Denver specifically is in rough shape, where spending here is down almost 7% from last year. That's from Bank of America data. And it's flat overall in the United States. And right now, I'm seeing something that just doesn't really make sense. I think people are forgetting about Chipotle, specifically how good the unit economics are for this business. And Chipotle is having some issues where guest traffic is down a little bit. It seems to be flattening out. And I'm now seeing things like a CNBC headline that says, quote, younger consumers are eating less Chipotle and Cava. They are buying more Coach bags. Things that I don't know if they should belong in the same headline. And one of the reasons that Chipotle is really getting beat up is the 25 to 34-year-old cohort is eating out less often. This is something CEO Scott Boatwright pointed out. He said, they're just eating with us less frequently. They're eating at home more often. And while visits to casual dining chains are up a little bit, fast casual is down. So there's these headwinds that everyone is focusing on, which is the younger cohort is going to Chipotle less often. You know, we talk about how a lot of the spending in the economy is driven by the top 10% of wage earners. Restaurants like Chipotle need the bottom 90%, and they are struggling more right now. Mm-hmm. But when I look at Chipotle, when I zoom out a little bit, this is a business that does extraordinarily well. And the one number that, and they point this out in their earnings calls quite a bit, is that the year 2 cash on cash returns for new restaurants, which is just what is the pre-tax return for the amount of money we put into a new restaurant after it's had a little bit of time to get going. That number is 60%, 60. They're getting most of their money back the second year that these restaurants are open. This is an incredibly profitable business, even if it has a little bit of a headwind right now. And its earnings multiple is, I think, at its lowest point since about 2008. So I look at this company, Malcolm, and I think, you know, maybe these traffic declines are for longer than I am expecting, but this is a really good business at one of the lowest multiples that it's been in since I've been alive.
Yeah. So it's interesting because first of all, let me just say, I don't invest in restaurant stocks. I don't like the restaurant industry as an investment. The margins aren't there for me and like whatever. But I do know that Chipotle is sort of a unicorn in the space, fast casual specifically, because of everything you just said. One, it's got, I won't call it a cult following, but it's got a really strong customer base, myself included. I'd eat there all the time if my wife would let me. But it has also the right unit economics. Like they actually have the ability to increase prices by 50 cents, 75 cents, $1.25, just sporadically, and customers are willing to take those price increases in stride and keep on coming back. And so it is interesting to me that a company that is that good at creating cash in year 2 per store, I didn't even realize that was where their turning point was. I would have assumed it was more like year 4 or 5 like anybody else. But that's amazing to me because that says that the rest of the industry has a tough road ahead.
Yeah, and Cava, for as much of a growth darling as it is, it's about 35% cash on cash return for year 2. So Chipotle is almost double with that. Wait a second, why is your wife not letting you eat Chipotle that much?
To her, it's way too basic to be on the daily or weekly. I shouldn't say daily, but like on the weekly go-to list. For her, it's like way too basic.
She needs something more exciting.
Yeah, my wife's a foodie though. Like I'm a person. I'm a person who could eat the same 5 things every single week of their life and be just fine and have them in that rotation, which is actually what happened before we got married. Like I lived across the street from a Chipotle and a Jersey Mike's and a couple other spots, and I would just go to those places literally in rotation all the time. So anyway, I'm under the impression that Cava has more of a cult following from the investor community than it does from its customer base. Like I don't hear as many people in real life in the wild talking about going to Cava the way they talk about going to Chipotle. However, I hear Kava investors, Kava shareholders, especially around those who bought around the IPO, are like gung ho the same way Chipotle investors are gung ho.
Well, that's because they want Kava to be the next Chipotle.
Yeah.
And reality may be more simple, which is that Chipotle is probably the next Chipotle.
Yeah.
And Kava, when like their latest quarter, they are still seeing, I think they saw same store traffic revenue rise a little bit, or same transaction rise, but they cut basically the amount of growth going to those same restaurants, which means this company may be maturing, in my view, a little bit quicker than those gung-ho Kava bulls thought they were. And this was a company that I think, just to put this into context, at one point, Kava had a market cap of $40 million per store. Now it's about 13 million, which is closer to what Chipotle is. But I think the reason I'm so interested in Chipotle is because while people are getting less excited about this company, the unit economics are still insane.
Yeah.
And when I think about let's say younger Malcolms who are willing to go to a restaurant, the same one once, twice a week, Chipotle is great for that. And I'm seeing on social media the narrative change a little bit, where people are saying the portion sizes are getting smaller.
Mm-hmm.
I'm having a bad experience with the ingredients there. And I wonder how much of that is just a self-fulfilling prophecy. If restaurant traffic wasn't down by 1%, would you be saying that online, or are you just saying that so you can be proven right?
I think shrinkflation is real, though. I think we've been seeing this since like 2021, and we're still pissed off about it. We being consumers, like we're still pissed off about the fact that, whatever the thing is that you remember getting for $5, that the carton of juice that was, $3 for a 64-ounce carton is now a 59-ounce carton, and it's also $7. Like that's very real, and we see it and touch it and feel it all the time.
I want to get into this topic of the casinoification of the economy. And first, I'm going to tease this because Malcolm and we did an interview with MMA betting analyst Cody Saftik. He hosts a podcast called Bookie Beatdown. The reason I wanted to talk to him is because there's a lot of people chatting and having big thoughts about the casinoification of the economy and what it means from a societal level. Mm-hmm. And I wanted to get the perspective of someone who has been very interested in gambling and talking about it for him. He's been betting on mixed martial arts for 2 decades. So he's got a really insider perspective of it. And I thought, Malcolm, he was incredibly sober in the conversation that we had with him about the reality of gambling and what winners are able to do and just how rare they are. So that'll come out in a couple days, and I hope you get a chance to check it out.
I think that's probably more true than not, though, of professional gamblers, that they tend to be very flat. Like they tend to be very even-handed is probably a better way to put it. In their approach to risk and most everything else, and the wild personality that we tend to associate with professional gamblers from watching poker players on ESPN isn't really the rule. It's more the exception.
And just because I'm feeling Cody's presence, he is not a professional gambler. He did not like that label. He is I would say he is a mixed martial arts betting analyst who closely follows the industry. But I think you're exactly right. If you have wild swings of emotion, you can be a gambler, but probably not a professional over the long term.
Yeah.
But one of the reasons I want to get into with this gambling story, one is just there's more thoughts about, or more people talking about how the economy is rigged. I thought Kyla Scanlon had a very interesting piece in the New York Times. It's titled, "It is Trump's Casino Economy Now, You'll Probably Lose." And another reason I've been thinking about this is last week, we saw Coinbase CEO Brian Armstrong at the end of an earnings call go through a bunch of words. Like, I think it was like Bitcoin, Ethereum, staking. Okay. Now I think I have said all the words that the prediction markets bet that I would say. So he was openly manipulating what is alleged, or not even allegedly, he was openly manipulating a market, and everyone was like, that's a goof. And yet you're seeing a lot of these athletes getting arrested by the FBI for coming out of a game early and sharing that information. And so I'm just like, man, there is such a huge disconnect right now in this economy, especially with people I want to phrase this carefully, allegedly affecting the outcomes of certain prediction and gambling markets.
Yeah, I should probably couch all of this commentary in saying that this is coming from a person who gambles twice a year and probably loses all of $20 on all of his bets. So, do with that what you will. It's probably not a surprise to much of anybody who's followed anything I've said publicly, but it's fun. Enjoy it for what it is. I walk through a casino, I see the roulette wheel and I say, ooh, and then I bet $200. I lose $40. I win $60. An hour has gone by and I say, that was fun. Time to go. That's the extent of the kind of gambler that I am. So all that to say, I pretty much ignore a lot of what happens out in the ether as it relates to betting. I'm watching football games with friends and they all have their phones up and they're staring at their phones, shouting about parlays and yelling at a receiver to run 2 more yards before they go down. All kinds of things like that I get it helps make the game more exciting, but it also just, for a person who isn't into gambling, makes you annoying. So I feel bad for all of the women who I watch responding to the guys who are so wrapped up in this $18 bet that they have that they can't even enjoy the thing that's happening in the moment because they're so focused on this $18 they have on the line. For all of the women who have to be associated with the guy who's so wrapped up in his parlay, I feel for you.
I've seen that. I mean, I've been on hikes with people. I'm thinking of instances where I'm out socially with someone and they are so worried about not just a $20 bet they have, but hundreds of dollars of money, hundreds, more than $100 they put on a specific bet because some algorithm told them to. And it may be profitable for them, but I'm your attention is so far away from not just this social event that we're at right now, but I'm sure many others. And when you're at home, this is probably where your mind constantly takes you back to almost like a destructive meditation where it's your mind constantly returns to the parlay or what bet you're doing next. And I think you're exactly right. It makes people less interesting. And the thing that's happening with gambling is it's become so widespread. It's this base primal human desire that people have. And 2 things are true. One, people have always wanted to gamble. They have found the knuckle bones of, I think, sheep, which are these ankle bones that people would throw against a wall and they would bet on the outcome. And we've also seen it was China and India and other societies, literally since the time of Jesus Christ, for thousands of years, societies have known that they need to put guardrails around how people gamble. And the way we used to do this is that there was basically zoning for it, right? You had to go to a casino. You had to go to let's call it a vice district like Las Vegas in order to gamble. And now all of that is melted away. And you can do it on your phone. You can do it when you're alone. And I think that we are not ready for the implications of that, even as some of these companies mature. The bright side of this is that a company like DraftKings, its revenue only went up, and I say only because of the amount of money they spend on marketing, only went up 4% in this prior quarter compared to the previous year. So I think there's a lot of destruction that may be happening with this, but also we may be at a place where this market for gambling may be reaching a maturity and a saturation point in the United States for sports. That may change if these companies are able to get iGaming through, which is not just can you bet on your phone, but can you go play roulette on your phone? Because for you, Malcolm, you go to a casino, you might play roulette twice over the course of a year and lose $20. But for an addict, now that roulette wheel is constantly in their pocket, beckoning to them. So,
well, I think
it's a lot of thoughts.
That's part of the bigger issue, though, is that we're essentially saying, similar to cigarettes, we know the only way that we make real money in this thing is if we can get you addicted. And then we're going to do everything we can to put it right there in your face. Cigarettes you can buy at a gas station on any corner, a 7-Eleven on any corner, from the guy walking down the median strip who's selling loose cigarettes. Like, you can literally get a cigarette anywhere you want it, anytime you need it. And that's basically how we're, to your point, if we've institutionalized gambling this way, so it's in your pocket, at your fingertips all the time, we're preying on people who have a problem to be the biggest spenders, the whales that keep this whole thing going. They're not worried about capturing the person like me who's a casual fan who every once in a while will just pop in because everybody else around you has brought you to this place. And so why not? They're focused on how they extract the most from the person who has the least, basically. Because if you're an addict in that way, you've already risked, all the big dollar, big ticket items that you have to put on the line. And now you're down to, so it bothers me from a societal perspective that we are willfully acknowledging that the only way these big institutions can really turn a profit is to prey on people with a problem, an addiction. And we're going to say we're fine with that. Somebody's got to do it. Why not let it be me, basically?
And, to use the cigarette example, this is, there's a YouTuber I really enjoy named CoffeeZilla. And his point was for this, let's assume that gambling is a drug. It's a dopamine delivery device that some people get addicted to. Can you imagine if we saw ads for cigarettes saying, hey, if you buy your first pack of Marlboro cigarettes here, we're going to give you your next 50 packs for free. And that's essentially what these gambling companies are able to do on television, right? Place your first $5 bet and we'll give you $150 worth of bonus bets, knowing that for most people, some of them will be like you, but we're going to get enough addicts in there that'll eventually even out. Or at least that's the bet that these companies are making, because DraftKings, it's maturing. Maybe it will turn a profit at some point, but so far it hasn't.
I think though there's a separate piece of this. So we're
Sure.
relegating the entire thing to it's just folks who are addicted to gambling that stand to lose here. But I think we're also missing out on a bigger piece of society, which is people who are trying to get there in one shot. So There's a very large K-shaped economy that we keep talking about and kind of blowing past. So we when I'm on CNBC, for example, there's a conversation about the consumer for about 5 minutes of every hour-long show, right? And we're talking about how well the consumer is or isn't doing. And at the moment, we're talking about how the consumer isn't doing so well. They've stopped going to Chipotle. They've stopped going to Target and traded down to Walmart. They've stopped buying Kimberly-Clark products and instead are buying the store brand. Like, we talk all this time, and that is true, but it's the person or the people who are at the lower end of the income spectrum. 50% of all the consumption that's happening right now out there in the economy is happening from the top 10% of income earners. And so what's happening is the people in the bottom half of that are trying to close the gap in one shot. So, all right, I can't go buy, XYZ luxury item on my salary alone. So if I hit it big on this parlay, then that's going to allow me to take those dollars and go do the thing that helps make me look and feel as if I'm part of that top tier. And everyone is trying to get there in one shot. It's the same reason the stock market has been so gamified. Like, okay, it's hard for millennials and Gen Zers to buy houses like you initially were alluding to. I know I'm going to take everything that I've got, bet it on this parlay, and if the economics are in my favor, I just heard Scott Galloway talking about a bet that he made on the election. So, guys wealthy by anybody's measure, right? Decides I'm bored. I'm going to bet $300,000 on Kamala Harris to win the election. And if I win, I'll get like $1.2 million out of this thing because of how the numbers were stacked against her. And for him, $300,000 is probably the equivalent of me or you betting like 10 grand. And so for him to be willing to make that kind of a bet just for fun, for something to do, to hit it big on one shot, I can only imagine then what the people who are at that lower 90% of, income earners trying to get themselves into that top half of spending. And it's just a vicious cycle.
So I think you're getting to a point that I both agree with and I disagree with you on. I think some of it is economic. People certainly see this as, when you look at people who are, and Morgan Housel's talked about this, people who play the lottery,
mm-hmm.
right? And I know that I don't have enough to save for retirement, but I have, 10 extra bucks this week to go buy a Powerball ticket and maybe I can go win the lottery. I think there's certainly an element of that with gambling and parlays, but I also think a lot of it is, and this is something we talked about with Cody where it's a drug. And if you bet $20 to win $10, that doesn't hit the same as seeing a $20 parlay potentially ride out for $200 or even $1,000, those long shots that sort of beckon to a lot of people. So I think some of it's economic, and I think some of it also is the way that gambling can work as a drug. And, my perspective on this is Scott Galloway, I don't know if he did it out of boredom, because I put a bet on Kamala Harris to win the election. Mm-hmm. So I don't know if I was tailing him exactly, but the thought was that the betting markets were really overemphasizing Trump to win, because many of the prediction market players were bro-y dudes who thought he would win, when in reality, Kamala was showing up better in the polls. What happened again? The polls were a little bit inaccurate. The Nate Silver model wasn't quite right, and the bets on Trump end up paying out. So I don't know if for him it was boredom or it was a potential viewing this bet like a venture capitalist. That was a bet I took and I was wrong about. And I think the thing that's difficult for me to see with this phenomenon as well is just, I do think betting can be useful. I think gambling can be useful. I like playing poker with my friends. I've enjoyed being at a bar with people.
What's the buy-in for that poker game?
It's $30.
See? So it's low enough to be social and not high enough that folks are stressed out and not able to actually be in the moment and participate and have fun like it's meant to be.
And I've had people at the poker game, and this is, most poker games are a much higher buy-in than that. I've had people show up once or twice, and then they're like, I think one of the guys told me, it's hard for me to feel anything at this because the stakes are too low. And I'm like, that's the point, is we're playing cards and we're talking, and this is how you get a group of, for the Galloway point, I want a better idea than tax breaks for bars to get a group of young men to sit together for 3 hours and chat. I think poker is a wonderful way to do that. Gambling can be like a fire. It can burn people, but it can also be used as an excuse to gather and hang out with people. And to your point, yes, I think that's one of the, you keep the buy-in low enough.
But not if I'm doing it from my phone. That's the thing. Doing it from my phone forces me into isolation. We're alone together, basically. I was just at a Cowboys game, and the two guys sitting we had really good seats. So I know they spent a decent amount of money to be there. And so these two guys in front of me are paying more attention to all the stat lines on the side wall of the stadium than they are to the actual game on the field right in front of us. And I'm looking at that and I'm thinking two things. You're just making me think about this. So you have two guys that decided to get together on a Sunday afternoon to hang out together. And I've heard Trevor Noah talk about this, how guys, the way we socialize is we always need a third thing. For women, just get together to have a conversation or to see each other, and that's enough. But for guys, it needs to be you, me, and the third thing. So we're going to get together and watch this game. We're going to get together and work on this car. So they made the conscious decision to get together, have the third thing already. But then the fourth thing is that they're both staring at their phones and then staring up at the stat lines the entire game instead of watching the game on the field. And so you didn't really accomplish the social outing that you're describing. You could have just stayed home because basically you're here alone together. Save your dollars and just do that on your couch.
And you could totally bet on a game and then go to it with a friend. It's just taking it to the extreme where, I've gone to a baseball game before where, I put, I think it was Reds versus Rockies. I put $20 on the Reds to win, and I'm from Cincinnati, so I'm biased in that. And also the Rockies are a historically bad baseball team. So, and then I go with my friends and it's I got a little bet on the game and I'm enjoying it with my friends. There is a way to do it where it's like a drug. You can use it to elevate a little bit. It can raise the dopamine. There is a crash. You got to be careful with it, but it can be used to enhance social bonds. And I think that there's very little discussion of that in the conversation about gambling. I want to bring it back to investing though, as we start to close out, because these, if I just, set aside the fact that it's gambling for a moment, if I were to pitch you a company, Malcolm, that is, I have a dopamine machine that is highly addictive for its users, that I'll tell you a story where people go out into the world, they go to a game with their friends and they can't get away from it. And we know that we're going to eventually win money from those players. And yet these companies, DraftKings and Flutter, they've been pretty poor investments. I think Flutter's, you haven't, totally lost your money on these things, but if you saw, the Lynchian approach of, I see a lot of people interested in sports gambling. People are spending a ton of time on their phones. They're getting a bunch of new users. You have not been correct so far on those sports betting apps. And I think my reason for that is just because the amount of money they have to spend on marketing and the ease of switching. They have no moats. But I guess any thoughts you have, we can talk about it from a moral perspective or outside of it, for the underperformance of, we'll call them tech companies, these tech companies.
I think what you initially were describing was Facebook, right? So the dopamine hit of the like keeps me coming back to the platform. The dopamine hit of seeing my bully from high school doing worse than me keeps me coming back to the platform. The dopamine hit of seeing my, brother or sister's kids in their costumes for Halloween keeps me coming back to the platform. The difference is that one company and its two main platforms dominate. With the gambling apps, there's so many options. To your point, the switching is easy. It's frictionless. And so I can jump from one place to another. And the challenge that these companies have, you already outlined, I have to spend $1 gazillion on marketing to make sure that you recognize that our sports book is the sports book. But we also have 25 other competitors here in the States and another 50 coming from China and Russia and everywhere else. And so we can't really own our customer the same way that Facebook and Instagram own their customers. And I think that's the big challenge to the business model.
Yeah. And as we close out, I forgot to mention this, but I do think it's important. I think it is useful to view investing as a game. You can take this Kyla Scanlon approach to the economy and say, this is a rigged system. The Bernie Sanders, this is a rigged system. But what do you actually do? And I have a few ideas. Number one is just admitting you will lose money betting on sports. This is a losing proposition for you, even though it can be fun. Treat it like any other source of entertainment. I know that by going to the movies this weekend, I will lose money doing that, but I'm going to enjoy watching a movie, hopefully. The second is you can view companies as players in a game. And right now, so far, tech monopolies have done an excellent job. You look at a company like Google, which is at an all-time high, so I'm a little hesitant about the stock as an individual investor and just my own money. But you think about the game they just won with the antitrust case, where a federal judge, Amit Mehta, comes in and says, hey, Google, you all have an illegal monopoly over search. And I'm just letting you know that you have a monopoly, and we're going to let you know what the punishment is. You fast forward a year later, the punishment is they have to share some search data. They get to keep their advertising data private, and they do not have to spin off Chrome. There's essentially a parking ticket for these types of companies. So if you're thinking about the economy as a rigged game and you want to approach it cynically, go ahead. But I think looking for the monopolies doing the rigging is not a bad way to approach investing. And my third idea is finding companies that, play with their stocks. They're playing a game with their stock. And that game is that they get some earnings growth, but then they're buyback machines. So you look at a company like Dillard's, its 5-year return is pretty close to that of NVIDIA. And it's a pretty simple game. It's boring, but if you're able to maintain positive earnings and then just judiciously take down the number of shares that you have as a company, you will build your earnings per share. And that has tremendously benefited patient investors who are finding companies playing that game.
Snooze.
So Dillard's is an example. What's that?
I said snooze.
Snooze, you're bored? Are you bored? I know, it is boring, but look at the chart of Dillard's. It parallels NVIDIA. Please,
no, you're not
don't
wrong.
be bored.
You're not wrong. I was being facetious.
Get your dopamine boost, get a little dopamine boost from some speculative bets, but also you can treat some bedrock investments as a game, but it is more boring and it takes more time. And since I talked about the previous history of Dillard's, the company that I think may be able to pull that off in the future is PayPal, where fairly flat-ish earnings and revenue growth, but something that Alex Chris is not getting enough credit for is he has been pretty aggressive, in my view, of taking down the number of shares outstanding. And that is a game I like to pay attention to. Malcolm, any thoughts on that before we wrap up?
Well, first of all, I think you might have just set up a whole new show on financial engineering companies, because no one plays that game better than Apple, in my opinion.
Yep.
But separately from that, I think the only thing that I want to emphasize here when we talk about gambling and the gamification of the economy and all those other parts is that I think investors need to be able to approach the markets separating those two thought processes. I think that gambling, unfortunately, has created wild expectations for people for what the outcomes are supposed to be and made people dissatisfied with what should be great returns. So, there was a time when if you 2x, 3x, 4x'd your investment over the course of 5 to 10 years, you did a great job picking the right stock. And now I have people that show up at our front door for discovery conversations that'll flat out ask a question like, what's the next 10 bagger you got that's going to get there in a couple of years? And like immediately I know this conversation isn't even worth like being on my calendar, but I have to have the conversation and try my best to point them in the right direction just as a good citizen of the world. But I also know this person's expectations are so wildly out of control. Like there's no stock you can recommend that's going to make a person like that happy. So they got to take that energy over to DraftKings and hopefully hit that parlay. But I think that is bleeding too much into our approach to the markets now. I know I sound like an old dude like Warren Buffett or Peter Lynch or somebody like that, nobody wants to hear from at this point. But I just think that we as investors have to do our best to keep the casinofication out of our investing.
So keep the casinoification out. I might say keep a little bit of gamification if that's something that appeals to you, and understand that it's a very long game. Malcolm, we will be back one more time this week with our guest, Cody Saftik. I really enjoyed that conversation. I hope you, the listener, do as well. It is even deeper into this world of betting and casinos and how he views it as a professional gambler. Definitely a different perspective than what we have. He's not a professional gambler. He is someone who follows betting closely. He is not a professional gambler. Anyway, the most important thing is that I really enjoyed that conversation, and I hope you do too. Thanks for tuning in. If you get a chance and you enjoyed this podcast, best thing you can do to help out, send a show to a friend. You can also rate us and review us on Apple Podcasts and Spotify. That also helps out. I'm at Rick So Slick on Twitter, Ricky Mulvey, or at Rick So Slick on X, Ricky Mulvey on LinkedIn. You can find Malcolm at Malcolm on Money. And that's all we got. Thanks for joining us.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.